Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. So this week, or this month, I should say, we've seen some pretty big changes in the market. I'm not going to get into the data this week since we're almost at the month's end, so I'm going to wait until next week for that. But let's just say the inventory has dramatically increased, and all those multiple offer situations and, multiple bids, they're kind of going away right now, especially in the GTA. The rest of the areas, kind of where I'm from in Niagara region, we don't really see that much, or we haven't seen that much from the previous months, as opposed to like places like Brampton, Mississauga, and whatnot. But yeah, from what I've heard up there, a lot of them aren't getting the multiple offers they wanted on offer dates, so they're increasing prices and trying to negotiate the old-fashioned way. The market has been described as unpredictable and kind of a little bit volatile by a lot of agents recently. So let's start off this week with this first chart. I put this together earlier in the week. I shared it on Twitter, and this is just a kind of a mock mortgage payment from someone that would have taken a variable rate at 1.5% back, say in late 2021 or even early 2022 when they had that rate hold. So on a $500,000 mortgage at 1.5% on a variable rate with a fixed payment of $2,000 per month, we can see how that has kind of progressed over the last year and a bit. So in the beginning there on the left, we started at 1.5%, $1,375 was going to principal, the rest was going to interest, $625. And you can see as it goes up to 2.5%, it kind of splits 50-50, 3.5%. Only about a quarter of that is going to principal. The rest is going to interest. Once we hit 4.5%, it's only $125 towards the principal and $1,875 towards interest. 5.5%. You can see now that it's all going to interest, and there's actually additional principal, or years of amortization, as they like to put it nowadays, but it is actually additional principal. And this is every month. And now at around 6.5% for variable rate mortgages, it's $2,000 or $708 a month additional going towards your principal. So very underwater. And this is my background this week. These people, they're totally underwater at this point. And actually, I have some examples here. So let's check out these examples. I got these from some followers on Twitter, and these are real examples of people's mortgage statements, recent mortgage statements. Here's the first one. And you can see down there with the circle around it, 72 years and 7 months. Now, this statement was, from what I believe, was a 2022 end of year statement. Yeah, it says right at the bottom there, rate as of December 31st, 2022, 5.45%. And they originated it in January 13th at 1.45%. And because of the fixed payment, their payment hasn't changed, which is still pretty high, $6,109. So this is a pretty big mortgage. And you can see it's now 72 years and 7 months, and that would have been at the end of December. So it's probably 80 plus years now, if not more. And here is the next one. This is a whopper of a one, and you can see their original balance, or the balance as of last payment at the top there, 1.23 million. This last payment, or the last payment, was done on June 16th this year. So this is a current statement. They have a prime minus 1.35% variable rate mortgage, obviously with a fixed payment here, as we can see further down. And the maturity date is in 5 years from now, or 5 years from origination. So that's 2027. They're up to 1,140 months, and it started at a 360-month amortization. So that's a 30-year amortization they originally had. And now they're at, if you work out the math, it's 95 years remaining on their balance of this mortgage, which is just totally insane. 95 years. Now, I've heard of even 100 years at this point, which is just insane. Like, these people are so underwater. I don't know how they're going to get out of this. I know that, okay, if interest rates came back down, that would start reducing amortization, I'm guessing, but I haven't really done the math on that. But I just don't see how this is sustainable. This is like a ticking time bomb just waiting to explode, right? Now, moving on to this next story. If you watch videos like mine, you've probably heard about this story, but I wanted to dig a little deeper into what actually happened here and what I think might have happened. So you've heard about OSFI getting involved with a couple of banks with some lapses in the underwriting. And you can see here from the Globe and Mail, CIBC under banking regulators remediation orders to fix mortgage underwriting lapses. So let's take a look at kind of the summary of what happened if you haven't already heard it from somebody else. The issues involve thousands of clients, many of whom had lines of credit that were secured against their homes. When these lines were combined with a CIBC mortgage, the total credit available exceeded allowed regulatory ratios. The problems discovered did not involve fraud, the sources said. So, of course, no fraud involved here with the banks. Nobody's defrauding anybody. But the issue was when you go to get a mortgage, the bank, they like to see that you only have so much credit or debt on your books. And they said, look, you got to pay off this loan or get rid of this line of credit, and then you'll be approved for the mortgage. But they didn't follow up. And I think we'll read that now. As an example, a client seeking a mortgage with CIBC already have balances outstanding on home equity loans or other lines of credit, either with CIBC or another lender. That could push them above the acceptable threshold for a total debt obligations relative to their home's value or their income. So these are most likely investors, right? People, they already have a home or home equity lines of credit, so they already have a house and they're looking to buy another house. These are obviously all investors, so the story says here. As a result, some clients were told they had to close other credit lines or other products as a condition of getting a CIBC mortgage. But sometimes the bank performed no follow-up to ensure clients did, even after the mortgages were issued. So now you have to remember, this involved thousands of clients. This wasn't just like the odd one that forgot to close their credit line. So what it says to me is one of two things could have possibly happened. I'm not saying they did, but they could have, which would be fraudulent. So either somebody at the bank was like, yes, you're approved for this mortgage, this new mortgage on this rental property, but you may have to make sure you close this other credit line to get approved. But we don't check, wink, wink, so they knew that they didn't have to. Maybe that happened, maybe it didn't. So another scenario would have been that the word got out through, say, other investors telling their friends, hey, look, you can go do this. They're not going to check if you close your line of credit, take the money for the down payment from your other house and your existing primary residence, say, put that on your new one. They don't check. They'll say that they do, but they don't. No problem. There you go. You have another house, another two houses, whatever the case may be. But of course, it's very convenient that they don't have measures in place to check for this kind of thing, right? Like your condition of your mortgage was close the home equity line of credit and you didn't do it. So were these thousands of people just like innocently forgot to close their lines of credit? Meanwhile, that's where their down payments were coming from for that second house, because that's how most of these people got it. They didn't get it through savings. They didn't save up from working extra jobs or working their primary job to get the money for this, right? So yeah, kind of odd that no fraud. They mentioned there was no fraud involved in this, but I tend to think differently. In some of these cases, CIBC has been able to make quick changes to a client's loan profile to bring them into compliance with regulatory requirements. For instance, the allowed debt ratio might only have been breached if the client's entire credit line was used, but if it was not, so the maximum amount the client could borrow was simply lowered. So they're cutting off people's credit lines. So hopefully they don't have any pre-sale construction or pending deals to close that they're planning to take from this. And I think there will be some of them that had been planning to take this, but they've lowered it or closed their credit lines now because the CIBC's kind of backtracking because of OFSI's requirements. Yet CIBC continues to find new batches of problematic mortgages on its books, even in recent months. So this was not like a last year problem or a 2021 problem. This is like an ongoing thing. So did this help fuel the spring market this year in GTA? Who knows? In Vancouver? Who knows? Anyway, let's move on to a couple more charts. Here are a recent update in the power of sales for the ITSO. This is the 20 boards surrounding the GTA. And you can see we've remained elevated, still very low. Like this is not a lot of bank sales or power of sales, just over 41. But you can see that we've remained a little bit elevated compared with the rest of the year so far, approximately double what the kind of average for the year was so far. This one was actually pretty interesting. I put this together this week, and this is kind of who benefited the most from these rising prices and inflation and whatnot. And you can see at the bottom, the median household income since 2005. 2005 is the base year for all of these. This is 100 or 100%. And our median household income since then has risen 75% or so. Compare that with the average house price in Canada, which is more than double that at 169% since 2005. And of course, the government has made out the best out of everybody. Their revenues from land transfer tax have increased 350% since 2005. So again, median household income up 75%, house prices more than double that, and land transfer tax, that's almost 5 times what the median household income has gone up. So it just goes to show you who benefits the most from inflation. It's always the government. They collect more taxes, whether it's land transfer tax or income tax or whatever the case may be. And lastly, released today, inflation slows to 3.4% in May. So it went up last month unexpectedly to 4.4, and now it's gone down to 3.4. And this article says mainly due to lower gas prices. Now, talking about inflation, recently I've had a few conversations with different people, and you might be watching some of you, where rents have gone up significantly. I'm talking hundreds of dollars because landlords now, they're getting hit with these increased interest rates. Their payments are gone up. They're not covering their costs. And of course, they're trying to put that off to the tenant. And some of them, they're allowed to do it. Some of them aren't. And the ones that are not allowed to do it because of the 2.5% maximum increase, and these are homes built before 2018, what they're saying is, well, I might have to just sell this place because if I can't carry it or if I'm running out of loss, I'll probably just have to sell it. So then the tenants are saying, well, if you sell it, I'm going to have to go get another place and pay even more than the few $100s you want to increase it. So the tenants, a lot of times they're agreeing to this because they know they're going to be out of a place. So that inflation is actually running now or coming into the rental market. We're going to see huge and significant increases in people's rent as these rate holds take effect. And of course, they're going to try to pass off the expenses to the tenants ultimately, but that can only last for so long until the tenants revolt or something breaks. Anyway, that's it for this week. Thanks for watching, and I'll see you next time.